Hey guys, welcome to a new video. So in this one today, I'm going to be talking to you about CWII from REXSHARES. It's a growth and income ETF based on the underlying CoreWeave, which is in the power, AI, infrastructure kind of space. And it's been doing very well over the last couple of weeks. I have been keeping an eye on this since it launched 2 or 3 months ago. And I got into it fairly recently. Been kind of DCAing into the lows, and it has been doing pretty well. And I think that 2026 is going to be a big year for CoreWeave, potentially. And I think that this could be one of the kind of hidden gems, the dark horses in the high yield ETF space. It is a bit riskier than your mega caps like your NVIDIAs and your Teslas and your Amazons and all those kind of guys, but there is a lot more growth potential. It's a growth and income ETF, so there's a lot of upside opportunity and there's also a lot of income opportunity that goes with it. So that's what we're going to talk about today. But of course, before we get into it, there is the disclaimer. This video is not financial advice. This channel is purely based on my thoughts as I navigate my own personal investment journey. Please, please, please always do your own research. So CoreWeave, first of all, what is it? Well, like I said, it's in the AI space, but it's all about power and infrastructure, data center. So if you think of NVIDIA's like the chips, if you think of ChatGPT and OpenAI is like the chatbot, then you think about one of the pieces that they all need is the power, the infrastructure, the data center. And this is where CoreWeave sits. And it's one of the biggest partners of NVIDIA. It's actually NVIDIA's biggest holding as an investment. I got it here somewhere. So if you look at NVIDIA's investments, NVIDIA CEO Jensen says they invest in once in a generation companies. Here's where they put their money. So NVIDIA literally puts 89% of their money into CoreWeave. It's their biggest holding. It's crazy. 89%, APLD, ARM, NBIS, Nebius. I actually hold this as an underlying. It's going to do pretty well this year, I think. And then XRX, I don't know that one. But anyway, just shows that they are a vital part of NVIDIA's kind of plans, their holdings, their investment, and the power and infrastructure part of the AI boom over the next couple of years. So if you think that AI is going to be big, if you think it's a bubble, then this video is probably not for you. But if you think AI is going to really become something much, much bigger, then and you think that power, infrastructure, data centers, all that sort of stuff is important to AI, which it is, then CoreWeave could be an integral and very important part of that. And it could have a lot of growth because of the partnerships and the investments that are going into it as a part of some of the bigger players in the space. So NVIDIA, it's a huge, huge partner, but also some of CoreWeave's biggest customers are Microsoft. They are OpenAI themselves. So they've got huge customers, huge investors, and it's sitting pretty well at the moment. So that's kind of what CoreWeave does in terms of its AI space, its AI role. But what is it? Okay, so it's a REXSHARES ETFs. If you know, I love REXSHARES ETFs. I think they're a great mix between YieldMax and Roundhill. They have the growth and the income. They're a bit of a safer play than Roundhill because they generally pay lower distribution amounts. If you look here, CWII is currently paying 33% distribution rate, but I think this will probably increase. CoreWeave has had a really good week over the last week or two, and I think they will start to pay higher amounts. So I think this will increase, and REXSHARES generally only pay well when the underlying is performing well, which I like. I don't think you should be paying, 50, 60, 70, 80% on weeks where there's massive red days for the underlying. It just doesn't make sense. So I actually like the way that they set up their kind of portfolios, their investments, their strategies. And so, you probably know about REXSHARES. I've talked about it a lot in the past, but essentially half their portfolio seeks to generate weekly income via covered call strategy. So half of it goes to generating that income through covered calls, standard covered calls, kind of like what YieldMax does. And the other half remains for uncovered, allowing for uncapped upside potential. So this is also slightly leveraged. So it's balanced growth and income. So whereas YieldMax doesn't get all that uncapped potential, that uncapped upside, because it's capped at like 60, 70%. So if, say this was a yield max fund, if CoreWeave went up $10 per share, then CWI would only go up $6 or $7 because it's capped. And whereas with REXSHARES, it's uncapped, so they generally go up in line. Unlike Roundhill, which is even more leverage, it goes up over like 120% versus the underlying. Whereas REXSHARES, they basically capture pretty much all the upside because their leverage changes between 105 and 150%. So they do have downside, but it's not as much as Roundhill, and they're able to capture all that upside. It's just a brilliant blend between kind of the yield max covered call strategy and the slightly levered uncapped growth strategy of Roundhill. So that's why I really like it. Okay, so that's CoreWeave. That's the strategy. That's the distribution rate currently, 33%. Now, what has it been doing recently? Well, this is Snowball Analytics. This is what I use. I've been using it quite a lot recently just to get some data, some information on my investments, on my portfolio. So this is CWII. Now, it started off at $25 and it started going down. It didn't launch at a great time at all. We sort of went into this November period where there was this big sell-off, and then I was keeping an eye on it, and I thought we were getting near a bottoming zone, so I started buying into it. So I bought 34 shares back around 19th of November, bought another 15 shares, and then it dipped down very nicely around this time, around the 17th of December, 16th. So I bought a few more times here. Now I currently have an average cost price of $13.25, and it's been doing well recently in the last couple of weeks. That it's now sitting at $16.72. So my average cost price is $13.25, and it's now sitting at $16.72. So I'm up in share price, and of course I'm up from the distributions that I made as well. So what does that actually look like in terms of my portfolio? Well, I have 99 shares. The current value is $16.55, but my cost basis of my investment was $1,300. It's not a massive position, but it's a decent size for something that's slightly riskier than your mega cap fund ETFs. So I have a capital gain currently of 26%. I'm up 26% just on the share price alone because it's been doing, I bought the dips quite nicely, quite well, and then it's been going up fairly well over the last week or so, as we've had a pretty good start to 2026. And then, of course, I've been getting dividends on the side, which have only just started because I've only had it, a month or so. So $55 in dividends received. So my total profit at the moment is 30%. And this is really what I look to do for the single stock ETFs, is I really try to analyze them, because the single stocks are obviously riskier than you're buying your baskets, like your chippies and your Maggies and anything NASDAQ or 100 orientated, like your TDAX or your QQQIs. They're much safer to just DCA into. Whereas the single stock ETFs, I fundamentally believe you need to buy it at good times, at good entry opportunities, when the fund's dipping, when it looks like, when there's a lot of fear in the market. And I've done lots of videos on this, but I really feel that you need to try and time the market in a sense with these single stock ETFs. But anyway, considering I'm up 30% total profit after just a month or so, a couple of months is pretty amazing. But I still think there's opportunity here. So we've talked about it as an investment. What it does is it's the power, the infrastructure, data center play of the AI boom. What do the analysts think about CoreWeave though? So we'll look at CoreWeave as the underlying. So it's currently trading at $101. It's got a price target of $120. Now, it's got 33 analyst ratings. It's got a general consensus that it's in a buy zone right now. It's got 16 analysts saying it's a strong buy, 1 saying it's a buy, 15 saying hold, and only 1 saying strong sell. So consensus is hold or strong buy. Its financials are generally pretty good. Its EPS is a bit weird and weak, but in terms of like its actual financials and its fundamentals, it's pretty good. So consensus is strong buy and a hold. And I think that if you consider the all-time high of CoreWeave, 183, and it's currently trading at almost half that, which is just hit over 100, that there's a lot of potential to the upside. Okay, the analysts have it down here, but I think most of these ratings were when it was bottoming down here. So there is a bit of risk here. Like, you have to understand that this is a single stock ETF. There's risk in this play. This isn't, an NVIDIA, a Tesla, an Amazon. This is a slightly riskier play. As well, there is the thing with the AI boom. Is it a bit of a bubble? Is it not? Could AI stocks suddenly start tanking because they're overpriced? Yes, all of these things are considerations. This shouldn't be one of your biggest holdings, but I do think there's opportunity here. And some of the analysts and some of the research that I've done would say that that's also the case. Now, if we look at the performance so far in comparison to the other big tech high yield ETFs, so the NVIDIA's NVII, TSII, PLTW, HOOW, AMDW, then you can see that it's winning. Okay, it's doing very well. This is since the middle of November, when we kind of had that downturn in price. We had that correction, a bit of a sell-off, and since then CoreWeave is up 24% total return, and it beats the likes of TSII, PLTW, all the big guys that a lot of us are kind of holding. So it should be a smaller position, as it is for me, but I think there's quite a lot of opportunity for it this year. So is it a good time to buy? Well, obviously it's a buy as a consensus from the analysts, but if we go to, we'll go to CoreWeave. Oh no, yeah, we'll go to CWII. Why not? Have a look. And you can see that, okay, so my average cost price is around $30.25, I think it said here. So I was buying these dips, and here. This is when I started buying. Then I bought again in this dip, and I think here my average cost price is around here, $13.25. Now you might say, okay, well, we come up, we're a bit high at the moment. But if you think about the analyst ratings and the price predictions, the price targets, 208 is a max. And I think if AI does well, if liquidity comes into the market, if Trump runs the market hot, which I think he will, to try and win those midterms, then I think this is quite likely. 150. I mean, this is not financial advice. This is a riskier play. I, of course, do not have a crystal ball. Don't listen to anyone on YouTube. This is just my thoughts on what's going to happen this year. And I think CoreWeave is a pretty good play. So I think anything, you could potentially, if you wanted to DCA, you could start a small position here. And then when it comes down, if it corrects a little bit at some point around this $13, $14 zone, buy a lot more heavier here. If it comes down to $13, $14 again, then I'm definitely going to be buying more heavily into it, or at least DCAing into it. I'm not going to buy crazy heavy because it's more of a satellite position in the portfolio. I don't want to put loads of money into it because it is a bit riskier. And I want to be a bit more careful with my rules and how I structure my portfolio this year. So I've got to be better at that. But anyway, it's still a good buying opportunity in my perspective, considering what it does in terms of the AI space. It's that power, it's that energy, that data center, that infrastructure play within the AI space, within the AI boom. If you think AI is going to do well, then CoreWeave is one of the companies that's probably going to do well, considering its partnerships, considering its customers, considering everything that's fundamentally going on with the company. So anyway, that's just my thoughts on it. I just wanted to share that because I do think it could be one of the dark horses of 2026. I think it could perform brilliantly, but as I said, it's a little bit riskier. So do your own research. Make sure you don't put too much of your money, hard-earned money, into this one. But it could be a bit of a decent satellite play. I've got some quiet confidence that it will perform pretty well this year. So I'll leave it there, guys. Just thought I'd share that. I hope that's of some value, and I will see you in the next one. Cheers.